Bryan, can you introduce Fortitude and your areas of focus?
Yeah, sure. So we're a lower mid-market private equity investor. We typically invest in businesses that generate between $3 and $15 million of earnings across Australia and New Zealand. Most of our investments are partnership-style investments, so we typically take between 40 and 90% of the equity. For us, lower mid-market typically means the businesses we're the first capital into those businesses, and typically we take an approach of relative hands-on, where we might bring a CEO or a non-executive director or something like that to see if we can help out the business.
And are there sectors that stand out at the moment or that Fortitude tends to focus on?
Yeah, so certainly, like pretty much every other private equity investor, we look at healthcare and technology, and we'll continue to look at those. I think that for us, there's a couple of other areas we've done some investments in, such as food and beverage manufacturing, and as well as businesses exposed to the energy transition. So certainly businesses that have long-term structural tailwinds and that are supported by macro growth dynamics, and also those where we think a competitive dynamic. We over-index in businesses that are located outside of Sydney and Melbourne CBDs, and so typically they are 50 to 100 person businesses where we seek to include, as I said, a CEO or a non-executive director, and in those sorts of businesses, we think that those individuals can make a material amount of difference.
Yeah, I think can we expand on that part, which is how do you add value to these operating businesses?
Yeah, sure. So at least our philosophy at Fortitude is that we don't always try to make a business more like a Fortitude business, if you like. So if we're going to invest in a highly dynamic, agile food and beverage manufacturer, it's going to be quite different from a testing, inspection and certification provider. So there's not a kind of, this business must do this to become a Fortitude business. Rather, how do we increase that business's ability to continue to win by the dynamic that it has done historically? So usually we find small to medium enterprises benefit from agility, and so we try to put in place a structure to sort of put a governance framework around them, but to enable them to, take some more risk. So for us, certainly we have a 100-day plan that we put in place, but the most important part of our partnership is that up front we work on a 5-year plan. Agree with the management team. It's always wrong because things change throughout the investment period, but there's a structure to thinking that we continue to build upon. And then in terms of, to answer your question, we almost always bring with us an expert that has done something similar, so that whilst we're not making it more of a Fortitude business, rather perhaps that individual has seen an analogous situation, and they can make them feel more comfortable taking more aggressive bets because they've seen those things work in the past, if that answers your question.
And how important is liquidity opportunities or exit strategies, and has it evolved in the last few years?
Yeah, so because we invest in businesses that are often, as I said, $3 to $15 million of earnings, and therefore typically they're, for us, an equity check of 10 to 50 at exit, they might be going well a few $100 million. In the reality, most businesses going well will be 50 to 100. So liquidity in that instance, an exit, is actually not as limited as some of our peers might find it when they're investing, $500 million and trying to sell, where there's material ACCC scrutiny over a business of that scale. We have an investment at the moment that's going through an ACCC review. The buyer is so large relative to the acquisition, and by the way, it's a good outcome for us that it doesn't have to announce the acquisition because it's a sub $100 million enterprise value. It's seen as being business as usual in terms of the acquisition. So we think there's less friction points, if you like, for liquidity and realisation at our part of the market. In terms of ongoing liquidity, there's probably two parts of the answer for that. One is that most of the investments that we make, because of their size and scale, we don't overly lever them. So usually there'll be 1 to 2 times earnings of debt in the businesses, and so they can pay relatively consistent dividends, all going well, of course. So that means that in some instances, and we have a business that's done this, the business can pay a 50% yield profile, over the first couple of years of that investment. So the liquidity is realised there. I think we're also conscious that for some of our investors, they're seeking more structured liquidity options, and so we're working on products which can enhance that. And so there's a product we've recently launched which provides some of that context.
And how are you feeling the theme or the demand for domestic private equity?
From an investor perspective?
Yeah, from an investor, yeah.
Yeah, I think that, we're certainly conscious there's been a bunch of feedback from a DPI, as in dividends and cash return for investors. And so we're conscious that we as an industry need to do a better job, I think, on returning capital sooner rather than later. We think that our track record, self-serving of course, but has been relatively consistent over the last 10 years of cash returned, and pleasingly we've generated a number of investments in the last 5 years which have not only been strong cash generators throughout, but also decent cash returns at exit. We need to keep enhancing that profile as Fortitude and as an industry, I think. In terms of demand, I think that demand is maturing both for us and as an industry, where we need to be making our investors more aware of the differentiators, such that our position in the lower mid-market means we think that there's wider exit windows, more ability for a broader and deeper pool of acquirers that are different from those at, as I said, $500 to $1 billion enterprise value. And I think also we need to ensure that our investors are getting the products that enable them to feel more comfortable with that sort of allocation. And so I guess the reason for creating an evergreen fund with ongoing liquidity options every quarter is responding to some of that more sophisticated demand. We've to date been a deal by deal, investment by investment fundraise. We're conscious that as we continue to mature as well as a manager, not all of our investors want that exposure. Several do, but several want a kind of more, as I say, sophisticated and balanced approach to investing in private equity as the industry matures in Australia. And we're okay to evolve for that purpose. So demand for that has actually been really good. So we've made about $70 million worth of new investments in the last 3 months, and we could have made that 3 times or more. So demand has been good, but recent track record has also been pretty helpful for us for that capital raising.
Bryan, thank you.
Pleasure. Thanks for having me.